Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. U.S. equity markets have been testing towards and making new all-time highs of late, and they could conceivably continue to do so across the rest of summer, as fears about persistent inflation and the Federal Reserve's response to that threat have effectively been laid to rest, at least over the short to medium term. Stock markets have been buoyed by QE, or central bank asset purchases, and although the Federal Reserve does not explicitly buy individual stocks, some of the $140 billion per month it pays to sellers of bonds and other assets inevitably ends up in the stock market. What's more, according to research from J.P. Morgan, retail investors in the U.S. are on course to pump an additional $1 trillion into the market throughout 2021. There's an old market saying that a rising tide lifts all ships, meaning the sudden inrush of the sea, or in this case, an ocean of cash, raises every vessel or share price off of the seabed. A question that Wall Street traders and analysts ask themselves all the time is, has anyone or anything been left behind by the rally and the influx of cash that supports it, and if so, why? The reason that this kind of debate and research is so important is that it can highlight opportunities, stocks and sectors that have been overlooked or forgotten about. Let's show you what we mean. A month ago, one of our analysts ran a simple stock screen among S&P 500 constituents, looking for businesses that had grown their EPS, or earnings per share, by more than 25% over 5 years, and which at the same time had grown their sales by 15% or more over that period. That screen identified 27 stocks within the S&P 500 that met the criteria. It included companies such as Nvidia, Paycom, Amazon, Dexcom, Salesforce, and many other household names. No surprises there perhaps, but what is surprising is what happened next. Over the last month, many of those stocks have risen substantially. For example, Nvidia and Dexcom were up 22.07% and 21.48% respectively over those 4 weeks. The majority of the stocks in the list had a positive monthly performance, and just 7 shares from that list were down in price over the monthly time frame. Are the returns just a happy coincidence? Perhaps. However, the data also serves to show that markets and their participants are far from perfect or 100% efficient, and that even in market testing at all-time highs, there are undiscovered opportunities. The next question, of course, is, are there many other opportunities that have been overlooked? That's something of a $64 million question, and one that we can only really know the answer to with the benefit of hindsight. That said, there are places that we can look. For example, one measure of performance in market breadth is the percentage of stocks in an index that are trading above their 200-day moving average. Current data shows us that 90% of S&P 500 stocks are trading above that 200-day average, but what about those that aren't? Once again, a simple stock screen allows us to identify a list of 50 stocks that are trading below that key moving average. 44 of these had share prices that were up over the prior week, and 15 of these had outperformed the S&P 500, with gains larger than the index return, 2.7%. Indeed, the best performer in the group, Cabot Oil and Gas, rose by 9.72%, with Discovery.com up 7.06%, and Hologic better by 5.24% over the previous week. The screens that we have run here have been relatively simplistic and have concentrated on the broad-based blue-chip stocks that make the S&P 500. But of course, there are many more indices and thousands of more stocks for investors to consider. For example, if we were looking for momentum stocks, that is, stocks whose share price has consistently risen over the last quarter, month, and week, then we could probably do worse than look at the constituents with the S&P 400 mid-cap and S&P 400 small-cap indices. I say that because the small-cap index is up 24.1% year-to-date, and the mid-cap index by 18.2% compared to the S&P 500's 14% gain year-to-date. Looking at stocks in the mid-cap grouping that are up over the last year-to-date, last quarter, last month, and last week, we find a list of 162 names. We can whittle that list down to 114 if we screen only for stocks that have outperformed the index over the year-to-date. We can cut the list to 85 stocks by further filtering for those that have outperformed the mid-cap benchmark over the last 3 months. And that figure falls to 73 if we look for those names that beat the index in the last month as well. We could further thin the list by screening for those stocks that have outperformed the index by a factor of 5 over the last month, by having risen 8.1% or more. That gives us a list of 32 stocks that are up over the year to date, and all periods in between, and whose price momentum appears to be growing substantially in an index that is itself rising and outperforming its peers. In the short space of time available to us today, we have been able to look at 3 different types of screens that use 3 different types of data. Each of these screens had a simple format, and each created a list of stocks which were potentially worthy of further analysis, and that's valuable market intelligence. Traders on Wall Street are looking at the market in this way to spot opportunities and create ideas on a near continuous basis. However, there is nothing to stop the retail investor from doing the same as we have demonstrated here today. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.